Ladies and gentlemen, let me ask you something right now. Have you ever felt stuck? Have you ever woken up in the morning and thought, is this it? Is this all my life is going to be? If you felt that way, I want you to understand something immediately. You are not broken. You are not weak. You are not lost. You are simply at a moment of decision. And that moment right there is the most powerful place you can be. Because feeling lost is not the end of your story. It is the beginning of transformation. When people say they feel lost, what they really mean is they've lost connection. Connection to their purpose, their passion, their power. And here's the truth. Clarity does not come from thinking. Clarity comes from action. Most people sit around waiting to figure out their life before they move. But life rewards movement. Momentum creates meaning. If you feel lost, the first thing you must do is change your state. Your psychology controls your decisions, and your decisions control your destiny. Stand up differently, breathe differently, move your body, because emotion is created by motion. You cannot stay stuck in a powerful body. Change your physiology, and you change your life. Let me ask you something powerful. If your income disappeared tomorrow, what would still remain that could generate value? The answer is your human capital, your skills, your knowledge, your experience, your mindset, your adaptability. These are not expenses in your life. They are appreciating assets. In economics, nations grow when they invest in human capital through education, innovation, and skill development. The same law applies to individuals. When you feel lost, you are not lacking direction. You are underinvesting in your most valuable asset, yourself. Human capital also includes intangible assets such as emotional intelligence, discipline, communication ability, and problem-solving capacity. In modern economies, these soft skills often differentiate high performers from average contributors. Technical knowledge may open doors, but adaptability and strategic thinking sustain long-term growth. Labor markets evolve rapidly. Technological disruption reshapes industries. Those who continuously reinvest in learning maintain relevance. Those who stop investing experience skill obsolescence. The difference between stagnation and progress is continuous capital accumulation. Consider the compounding effect. A small daily investment in learning may appear insignificant in the short term, but over 5 years, it transforms your market position. Increased productivity leads to higher income potential. Higher income enables further investment. The cycle reinforces itself. This is endogenous growth at the individual level. You become both the investor and the enterprise. When uncertainty clouds your direction, shift your focus from outcomes to assets. Instead of asking, what job should I pursue? Ask, what capabilities will make me valuable in any environment? When you strengthen your human capital, opportunities expand organically. Employers compete for competence. Markets reward innovation. Networks respond to expertise. The most stable economy you will ever operate in is the one within you. Build it deliberately. Invest in it consistently. Strengthen it strategically. Because when your human capital grows, your options multiply. Your confidence stabilizes, and your future becomes less dependent on chance and more dependent on capability. Human capital functions exactly like productive capital in an economy. A machine increases output. A trained mind increases opportunity. The more advanced the machinery, the greater the production capacity. Similarly, the more refined your skills and competencies, the greater your earning potential and influence. The market does not reward confusion. It rewards value creation. And value creation begins with capability. If you feel uncertain about your future, the fastest way to reduce that uncertainty is to increase your competence. Competence builds confidence. Confidence drives action. Action creates results. Think in terms of return on investment. Every hour you spend developing a high-demand skill is an investment with future cash flows. Every book you read, every course you complete, every practical experience you pursue compounds your economic value. Unlike physical assets that depreciate, Well-maintained human capital appreciates over time. Skills that align with market demand generate higher returns. Adaptability ensures resilience during economic volatility. In labor markets, individuals with specialized and transferable skills experience lower unemployment risk and higher wage growth. That is not motivational language. It is economic reality. Here is the hook. You are not lost. You are underleveraged. When investors see an undervalued asset, they invest more aggressively. When you see gaps in your abilities, that is not a weakness. It is a signal for strategic investment. Conduct a personal skills audit. Identify which competencies generate the highest marginal return in your field. Allocate resources, time, money, energy towards strengthening those competencies. This is not random self-improvement. It is targeted capital formation. Let me challenge a common misconception. Certainty is not safety. In economics and finance, risk is unavoidable. Markets fluctuate. Industries evolve. Technologies disrupt entire sectors. The individuals and institutions that survive are not those who eliminate risk, but those who manage it strategically. When you feel lost, uncertainty often feels paralyzing. But uncertainty is not the enemy. Mismanaged risk is. In investment theory, diversification reduces volatility. By allocating capital across multiple assets, investors protect themselves from catastrophic loss in any single area. The same logic applies to your career, skills, and personal development. If your entire identity and income depend on one narrow specialization, without adaptability, you increase vulnerability. A single market shift can destabilize your position. Diversification creates resilience. Here is the hook. Dependence creates fragility. Diversification creates power. Risk diversification in personal growth means expanding your capability portfolio. Develop complementary skills that enhance your primary expertise. If you are technically skilled, strengthen communication and leadership abilities. If you operate in a creative field, learn financial literacy and strategic planning. These additional competencies function like diversified assets. They buffer against volatility in any single domain. Labor markets increasingly reward multidimensional individuals. Employers value adaptability, cross-functional knowledge, and innovative thinking. When industries transform due to automation or global competition, diversified professionals pivot more easily. They reallocate their human capital toward emerging opportunities. In contrast, narrowly specialized individuals without transferable skills face higher adjustment costs. However, awareness of opportunity cost is not meant to create anxiety. It is meant to sharpen decision-making. Rational economic agents evaluate trade-offs deliberately. When you feel uncertain, instead of asking, "What if I fail?" ask, "What is the cost of not trying?" Often the perceived risk of action is smaller than the hidden cost of inaction. Failure provides data. Delay provides regret. Here's another powerful hook. Clarity is earned through engagement, not contemplation. You cannot calculate every variable before moving. In dynamic markets, information emerges through participation. Entrepreneurs rarely have perfect forecasts. They act, observe feedback, and adjust. This iterative process reduces uncertainty over time. Action generates information. Information reduces risk. When you hesitate due to fear of making the wrong choice, remember that opportunity cost applies even when the decision is imperfect. A suboptimal action still produces experience. Experience increases human capital. Increased human capital expands future options. In contrast, doing nothing preserves uncertainty. Economically, a moderate return is superior to zero return. The discipline of recognizing opportunity cost encourages proactive behavior. It forces prioritization. It demands evaluation of alternatives. If you allocate time to low-value activities, you forfeit high-value growth. If you remain in an unproductive environment, you sacrifice exposure to better opportunities. Strategic individuals continuously compare alternatives and adjust allocations toward higher yield paths. In microeconomics, rational agents evaluate marginal cost versus marginal benefit. If the marginal benefit exceeds the marginal cost, the action is justified. So apply this logic personally. Reading 10 pages of a professional book may not feel transformative. Practicing a skill for 30 minutes may not seem revolutionary, but if the marginal benefit of those actions exceeds the minimal time cost, the rational choice is consistent engagement. Over time, these small investments generate exponential returns. Compounding is not only a financial concept, it is a behavioral one. Consider interest accumulation in capital markets. A modest rate of return, reinvested continuously, multiplies the initial investment beyond expectation. Personal growth functions identically. One improved habit reinforces another. Better time management increases productivity. Increased productivity builds confidence. Confidence encourages risk-taking. Risk-taking expands opportunity. Each marginal gain strengthens the next, creating a self-reinforcing growth cycle. The mistake many individuals make is underestimating marginal utility. They seek immediate, visible results. Yet economic value often emerges gradually. Firms that improve operational efficiency by even a small percentage gain competitive advantage over time. Similarly, if you improve communication skills slightly each week, within a year, your professional presence shifts dramatically. Marginal improvements reduce overwhelm because they are manageable. They reduce resistance because they are achievable. Let me challenge you with this idea. Large goals intimidate. Small disciplines liberate. When you commit to minor daily enhancements, you remove the psychological barrier of perfection. You do not need to be exceptional today. You need to be slightly better than yesterday. That is economically sustainable growth. Marginal improvement also reduces risk. Instead of allocating all resources toward one uncertain transformation, incremental progress allows adjustment. You gather feedback continuously. If a strategy yields low return, you pivot at minimal cost. This mirrors how efficient markets adapt. They respond gradually to information rather than collapsing under drastic shifts. There's also a psychological dividend. Small wins create momentum. Momentum increases motivation. Motivation sustains consistency. Consistency compounds outcomes. The cycle becomes autonomous. What began as a minor adjustment becomes structural change. When you feel uncertain about your direction, resist the urge for dramatic reinvention. Focus instead on optimizing at the margin. Improve one skill slightly, refine one habit, strengthen one professional connection, reduce one inefficiency. Each marginal gain expands your capacity over time. Those incremental upgrades redefine your identity. Economic growth at the national level rarely results from one single innovation. It results from countless small efficiencies across sectors. Personal growth follows the same pattern. The discipline of marginal improvement transforms uncertainty into manageable progress. And manageable progress, repeated consistently, becomes extraordinary transformation. Let me start with a direct question. If your time were traded on a stock exchange, would investors buy it? In economics, resources are scarce, and scarcity forces strategy. Time, energy, money, and attention are limited assets. The way you allocate them determines your output, your productivity, and ultimately your trajectory. When you feel lost, the issue is often not lack of potential. It is inefficient allocation. Every economy faces the fundamental problem of scarcity. Governments and firms must decide how to distribute finite resources to maximize growth. Individuals face the same equation daily. You have 24 hours. You have a certain amount of cognitive energy. You have limited financial capacity. The question is not whether you possess enough resources. The question is whether you are directing them toward high return activities. Here's the hook. Distraction is the silent tax on your future. In economic theory, efficient allocation occurs when resources are directed toward their highest value use. If capital is invested in low productivity sectors, overall growth slows. If your attention is invested in low value habits, Excessive social media, unproductive environments, reactive tasks, you are effectively misallocating your most valuable asset. The cost is invisible in the short term, but devastating in the long term. Strategic allocation begins with prioritization. Identify which activities generate the highest return on investment for your goals. Skill development often yields long-term dividends. Health maintenance preserves productivity. Networking expands opportunity sets. These are high-yield sectors of your personal economy. Compare them to low-return expenditures of time. Activities that neither build capacity nor restore energy. Rational agents shift resources toward higher marginal returns. Energy management is equally critical. In production theory, output depends not only on capital but on efficiency. Two individuals may work the same hours, but the one who operates with focused attention produces greater value. Sleep, nutrition, exercise, and mental clarity are not lifestyle luxuries. They are productivity multipliers. When energy declines, the quality of decisions deteriorates. Poor decisions lead to inefficient allocation, creating a downward cycle. Financial allocation follows similar principles. When income is directed entirely toward consumption rather than investment, wealth accumulation stagnates. Even modest savings directed toward learning, certifications, or business development can expand earning capacity. Strategic spending enhances human capital, which in turn increases future income streams. Let me offer another hook. You do not need more hours, you need higher leverage. Leverage in economics refers to using limited input to generate amplified output. Technology provides leverage. Systems provide leverage. Delegation provides leverage. If you spend hours on tasks that could be automated or simplified, you reduce your strategic bandwidth. High performers design systems that protect their most valuable resource, cognitive focus. They schedule deep work. They minimize interruptions. They protect peak performance windows. Opportunity cost reappears here as well. Every hour allocated to low-impact activity eliminates the possibility of investing that hour in growth. Over weeks and months, these small inefficiencies accumulate into significant lost potential. Conversely, consistent allocation toward high-impact sectors compounds advantage. Efficient resource allocation transforms uncertainty into clarity. When you know where your time and energy are going, you regain control. Instead of feeling overwhelmed, you operate with intentional structure. Instead of reacting to external demands, you prioritize internal strategy. An economy grows when it channels scarce resources into productive investment. An individual grows under the same law when you deliberately direct your time, energy, money, and attention toward high-return activities. You convert scarcity into strategic advantage. Let me challenge you with a sharp economic truth. Every minute you spend standing still is costing you something. In economics, there is no such thing as a free choice. Every decision carries an opportunity cost, the value of the next best alternative you give up. When you say, "I'll wait," you are not choosing neutrality. You are choosing the cost of delay. And that cost compounds quietly. When individuals feel lost, they often pause their progress, believing that clarity must come before action. But in economic systems, waiting without strategy leads to missed growth cycles. Markets move, industries evolve, skills depreciate. Time is not a passive resource. It is a scarce commodity with measurable value. The longer you postpone a decision, the greater the opportunity cost of unrealized experience, income, and learning. Here's the hook. Inaction is a decision, and it is usually the most expensive one. Consider a simple economic example. If capital sits idle instead of being invested, it produces no return. Over time, inflation erodes its value. The same principle applies to your potential. When your abilities remain unused, they do not remain stable. They weaken relative to a competitive environment that continues to advance. The labor market rewards participation and punishes hesitation. Every year of delayed growth reduces cumulative lifetime earnings and professional positioning. Opportunity cost is not just financial, it is experiential. The opportunity cost of not starting a project is the skill you could have developed. The opportunity cost of not applying for a position is the network you could have built. The opportunity cost of avoiding calculated risk is the confidence you could have strengthened. Each alternative path you reject has value, and that value must be acknowledged. Diversification also applies to income streams. Relying exclusively on one source of revenue concentrates risk. Even modest secondary projects, consulting, digital products, investments, freelance work can provide financial stability. During transitional periods, the objective is not overextension but strategic distribution. Multiple moderate streams often create more security than one large but fragile source. Another dimension of diversification involves experiential exposure. Engaging with different professional networks, industries, or cultural environments broadens perspective. Broader perspective enhances decision-making under uncertainty. In economic terms, exposure reduces information asymmetry. The more information you gather from varied sources, the more accurately you can evaluate opportunities and threats. Let me offer another hook. Growth requires calculated risk, not reckless leaps. Diversification is not avoidance of commitment. It is intelligent risk distribution. Entrepreneurs rarely invest all capital into a single untested idea without contingency planning. They test prototypes, gather data, and iterate. Similarly, if you are exploring a new direction, pilot it. Take courses, network within the field, gain part-time experience before full transition. This reduces downside exposure while preserving upside potential. Risk tolerance differs among individuals, but unmanaged fear often exaggerates perceived danger. Structured diversification transforms fear into strategy. When you know you have alternative skills, backup income options, and adaptive capacity, confidence increases, confidence improves performance, improved performance expands opportunity. There's also a psychological dividend to diversification. When your identity is not confined to a single role, setbacks become less devastating. You are not defined solely by one position or outcome. You become a portfolio of strengths rather than a single fragile asset. Economic systems thrive when they diversify industries, trade partnerships, and innovation sectors. Individuals thrive under the same principle by broadening skills, income channels, networks, and experiences. You create structural resilience. And resilience in uncertain environments is not just protection, it is strategic advantage. Let me ask you a powerful question. Are you measuring your life in days, or are you measuring it in decades? In economics, the most transformative force is not sudden profit. It is compounded growth over time. The principle of compounding explains how small, consistent investments generate exponential returns. Yet most individuals evaluate their progress through short-term emotional fluctuations rather than long-term strategic accumulation. When you feel lost, the temptation is to seek immediate results, but sustainable growth operates on a longer horizon. Here's the hook. Short-term emotions are noisy, long-term strategy is powerful. In financial markets, investors who react impulsively to daily volatility often underperform. Those who maintain disciplined, long-term investment strategies benefit from cumulative returns. The same behavioral bias affects personal development. One unproductive day feels like failure. One rejection feels definitive. But from a long-term perspective, these are minor fluctuations within a broader trajectory. The growth mindset in economics prioritizes structural trends over temporary disruptions. Compounding requires consistency. A modest rate of improvement, sustained over years, surpasses sporadic bursts of effort. If you enhance your productivity slightly each month, increase your knowledge gradually, and strengthen professional relationships continuously, the accumulated advantage becomes substantial. The effect may appear invisible initially, but over time it accelerates. Exponential curves always begin slowly. Consider productivity growth in an expanding economy. Annual growth of 2 or 3% may appear modest. Yet over decades, national income multiplies dramatically. The mechanism is reinvestment. Output generates surplus. Surplus funds innovation. Innovation increases output. This feedback loop creates sustained expansion. Personal growth mirrors this structure. Skill acquisition increases income potential. Increased income enables further education and investment. Each cycle amplifies the next. Let me challenge another assumption. Urgency is not the same as importance. Short-term thinking prioritizes immediate gratification, quick recognition, rapid financial gain, instant clarity. Long-term orientation prioritizes durable value, expertise, reputation, trust, mastery. These assets require time to mature. However, once established, they generate returns far beyond initial effort. Delayed gratification is an economic advantage. Choosing to invest in long-term capability rather than immediate comfort strengthens resilience. It reduces vulnerability to market shocks. Individuals with strategic patience make decisions. Aligned with future positioning rather than present mood, they evaluate trade-offs across extended timelines. Another hook to remember: consistency beats intensity. Many individuals attempt drastic change, sustain it briefly, and then revert to old patterns. This creates volatility without growth. Long-term mindset emphasizes sustainable habits. Instead of extreme measures, it encourages stable systems. Daily routines, ongoing education, and continuous reflection become institutional structures within your personal economy. Long-term thinking also stabilizes confidence. When your horizon extends beyond temporary setbacks, anxiety decreases. You recognize that one missed opportunity does not define a decade. You understand that growth curves fluctuate. This perspective enhances rational decision-making under uncertainty. Strategic planning over extended horizons encourages reinvestment. Rather than consuming all gains immediately, you allocate surplus toward further expansion. Advanced training, new ventures, expanded networks. Reinvestment fuels compounding. Economic expansion is rarely dramatic in a single moment. It is the cumulative result of disciplined, repeated investment decisions. When you adopt a long-term growth mindset, you detach from daily volatility and align with structural progress. Over time, the exponential impact of sustained effort transforms uncertainty into measurable advancement and potential into enduring achievement. So if you feel lost today, good. That means you're ready for a new direction. It means your old identity is dying, and a stronger version of you is trying to emerge. Don't run from that discomfort. Lean into it. Pain is not your enemy. Pain is a signal that you are growing beyond your old limits. Let me close with this. Your past does not equal your future. Say it with me. Your past does not equal your future. The moment you decide to take control, to raise your standards, to demand more from yourself than anyone else ever has, that is the moment your life changes. You are not lost. You are becoming. Now go out there and create the life you deserve. The world is waiting for the strongest version of you.